Media recognition from Bloomberg, Reuters, recycling trade publications. Patented process for 100% recovery of critical metals, including cobalt, lithium, nickel, manganese, aluminum. American Manganese is focused on recycling lithium-ion batteries for electric vehicles. American Manganese trades on the TSX Venture, AMY, the US, AMYZF, and Frankfurt 2AM. For more information, visit AmericanManganeseInc.com or phone me, Larry Ray, at 778-574-4444.
You're listening to HowStreet.com radio, available online at TalkDigitalNetwork.com. Welcome to HowStreet.com radio, the online source for market opinions. Here is Jim Goddard.
My guest is Danielle Park, editor of the popular blog Juggling Dynamite and president of Venable Park Investment Counsel Incorporated. Her websites jugglingdynamite.com and venablepark.com. Welcome back to the show.
Hi, how are you, Jim?
Well, Danielle here is struggling a little bit. She's been locked out of her house. and the neighbor's busy mowing his lawn next door, but the sound quality's good, so if you can just keep it together for us, we hope we have a great show.
I tell you, this working from home has its challenges, Jim.
Well, at least you know there's probably a nice cold drink when you get inside the house sometime today.
Oh, dear.
The U.S. dollar, what's the story there right now?
Well, the U.S. dollar has been quietly higher in the last few months. And with the rally in the stock market that's happened in the past couple of months again, the U.S. dollar has not confirmed that by going lower. So to us, it's suggestive of a trend shift that's been happening. And I think it's to do with the fact that generally speaking, liquidity in the world has been retreating since about March. So all the central banks that were pumping money into the financial system out of the March 20 bottom, they continued to do that with both barrels, but then credit impulses started to roll over. So the China credit impulse, which is their expansion of credit in their economy, but not only there, in the EU, and all five of the G5 actual central bank assets have been declining since March. So all that means is that there's less funds, even though there's still ultra-low rates, even though they're still doing quantitative easing, bond buying every month, there has been less of that. The central banks have been doing reverse repos to take some cash back off banks, because banks have been flooded with excess liquidity, and frankly, they aren't seeing any loan growth. They're not finding a lot of good people or businesses that can take on more debt. And when they look at the principal risk of making those kinds of loans, there's not great incentives. So banks have been doing things like leaving the money at the central banks, making tiny money on the overnight rate or getting it for free, and then just basically, using leverage to magnify that themselves. So all very non-productive, but also less liquidity. And we've seen this in the past through all the other cycles. When the central banks were ramping up bond buying, quantitative easing, you tended to see the dollar fall off. And when the trend began to reverse, you tended to see strength again in the U.S. dollar. So that's in fact what we've been seeing since about March. We actually added to our U.S. dollar positions for our Canadian accounts this week. And the main significance of all that is that I've described this before, the dollar teeter-totter, so the U.S. dollar on one end with Treasury government bonds on that same end, and basically all the other risk assets on the other. So when the U.S. dollar is falling, it tends to be inflationary. Import prices are higher, for example. Commodity prices are higher because they're all priced in U.S. dollars. So as the U.S. dollar falls, those inflationary inputs tend to get people all concerned about inflation. They tend to, be expectation of that continuing, and then you see risk assets rally. But the opposite is also true. Once you see the U.S. dollar begin to rise, those inflationary forces begin to reverse, and in fact you see commodities correcting and risk assets correcting. And that's in fact what's been happening since March. If you think about it, the SPACs of the world, the cryptocurrencies, of course, Bitcoin was dropped by about half, but many of the other, even sketchier things like Dogecoin and all that were down 80% just in the last couple of months. So it seems like the stabilization in the U.S. dollar may be an early indicator that we've seen the peak of the inflationary bias and expectation in this cycle, and that the next wave is likely to show that there's a downside test in the other end of the teeter-totter. So that's all the, cheap emerging debt and junk debt that companies have issued, and it's the commodities complex, it's the cryptos, it's the equity markets. Everything basically is that one trade on the other end. So we're just kind of watching that very carefully. And the other aspect, of course, is that Treasury yields as well have not made a new high. They were rising into March. The end of March, they peaked in North America, and they've been on a downtrend since. So again, the equity market may be anticipating, the Biden announcement today of the infrastructure package. Just under $1 trillion has apparently been agreed. Of course, won't be spent immediately, and indeed is to be feathered in over the next decade. So not a really big deal, and less than people were expecting or hoping, or the Biden administration had been promising some few months ago. So you sort of get to this point where, growth expectations are at the very top end of the range, expectation for continuation of that and inflation. And in fact, you're probably more likely to see a disappointment. In other words, all that's been priced into the risk complex on the way up, and now you're starting to see people realizing, hey, inflation's coming down a bit in the third quarter. Hey, commodity prices have come off the boil, and some of the risk indicators have come off the boil, and maybe we're going to see, growth in the second half of the year, but not the trend of growth in terms of the uptrend. The expectation is going to be disappointed. So all that stuff really sets up for a sort of sober reprisal of the pricing that's gone on in financial assets in the last few months.
Is the stock market in rocky shape right now? Is it about to do a major correction this fall?
Well, it's been in rocky shape for quite some time. There's been such a profound disconnect between the reality of earnings growth and sustainability of revenues, that sort of thing, business models. The investment cycle has been very much financialized and in preference for things like share buybacks rather than long-term investment that will actually help companies to survive and thrive over time. So there's been a lot of tenuous things going on in the financial sector and in the corporate sector, not managing balance sheets very responsibly, all because of this very low rate environment. So what's happened now is that there's a big gap between the prices, the valuations of these financial assets, real estate being another one, of course, and this is a really unique feature of this particular cycle, is that we now have this, these frothy conditions not only in the stock market or in the corporate debt market, but also in commodities and also in the housing sector. So when you have all those components together, some 80% of Canadian GDP, for example, has been derived from this frantic buying and building in the real estate sector in the past couple of years. And of course, when you get to a point where, the expectation, I always say the problem with free money, whether it's giving it to countries or to individuals, whether it's inheritance or otherwise, is that they tend to get weakened by that, and they tend to expect that you're going to get more of that, and they tend to be less resilient and careful. And that's exactly what we've seen this cycle. So now that, as I say, at some point you can't keep giving trillions and trillions and trillions of dollars out like it's candy to everybody, and the money that has been handed out has been largely spent on hard goods, consumer goods, which typically last several years and won't need replacing for a long time, in which case you've now dug yourself this hole of where does the growth come from as the economy reopens. Great. My hairdresser just called to say they can book me for July the 2nd, but I'm not going to go spend the haircuts that I haven't had. I'm just going to get the one that I'm due for now. So, those things are much less stimulus of economic growth. And so all of this really sets up the stock market for a reprisal, as I say. And the trouble is, as we saw in 2000, when you get this far away from, untethered from reality, from sustainability, from the probability of trends going forward, what you tend to get is a very profound downturn. So, it's your opportunity on the upside if you can have smaller bear markets is that you tend to have, less carnage. But when you've deferred it, and this has been this 11-year period of every time the stock market starts to try and do some repricing, there's some kind of intervention brought in to revive animal spirits, and people go back to really aggressive risk-taking. So we've seen that in spades this cycle, probably more than any other cycle, because as I've described, it's across every asset class pretty much. And so, Jeremy Grantham was just speaking of that in an interview he did with Bloomberg this week, where he pointed out, that it was it's very reminiscent of the 2000 bubble, which is, except we didn't have a real estate bubble at that point, so this one's actually worse. But the way the markets moved was that the NASDAQ, the tech-heavy, the theme meme stocks at that point were all around the .com, if you remember, Jim. And so the NASDAQ, in fact, had a doubling in the last year. Into March of 2000, it went up 100% in the year preceding. And then it rolled over. And the broader markets, the S&P, the Dow, the TSX, they all held up into the fall before they collapsed as well. And then you had a, 2-year bear market where things like the tech stocks were off 80%, but even the so-called blue chips fell by half. And so we've really sort of set ourselves up for that potentiality again.
We'll have more with Danielle Park right after this.
Engineer Gold Mines is focused on the exploration and development of the historic high-grade Engineer Gold Mine situated 32 kilometers southwest of Atlin, British Columbia. Engineer Gold Mines is fully permitted for surface and underground exploration with the drill program now underway. Engineer Gold Mines Limited trades on the TSX Venture Exchange, symbol EAU. For more information, please visit us at engineergoldmines.com.
Don't miss out. Stay informed. Receive the HowStreet.com weekly recap with thought-provoking podcasts, radio, and articles delivered to your inbox. Sign up for the HowStreet.com weekly recap on our homepage at HowStreet.com.
Welcome back. We're speaking with Danielle Park. Danielle, lumber had hit a record high. It's come down. Gasoline prices in Vancouver are expected to hit record highs this weekend, along with temperatures of 37 Celsius, body temperature 98.6 Fahrenheit. But is all of this inflation, these higher numbers, not including the weather, is this a temporary phenomena?
Well, again, if you think back to prior cycles, it's very common to see the energy complex outperform late in the cycle. And oil prices, in fact, they're oil and gas are one of the commodities that has held up into the summer, which is quite common. But we're 73 on crude today versus the 148 we were in 2008. So it doesn't mean we're in a secular expansionary period in terms of the price, but it does mean that it's highly cyclical. So as the economy opens and people began to drive again, and of course the producers had slashed their production, the OPEC Plus had agreed to pull in their production while the pandemic was on to try and support the oil price. And so they're now looking to catch up on pumping more product. So it's not a supply shortage. It's not that we don't have enough in the world. We've got lots, and in fact, we have more than the IEA predicts we're going to need for consumption over the next few years. But the reality is that, again, the pricing has really topped out. And then what happens, of course, is that the higher the price, the less people tend to want to drive. And they look for ways to save on their transportation costs. And so higher prices ultimately are part of the compulsion to use less or to figure out alternatives, and then you get the mean reversion in that price as well. But things, as I've mentioned, the last week we had a major commodities correction where it was across the board. It was metals, it was the agricultural commodities, it was precious metals, it was everything was selling off all at once, and that was again on the back in response to this dollar kind of bounce. So I think that they're all sort of at risk of if the dollar continues to strengthen. I mean, from 120 on the against the Canadian dollar, 120 has been the support level that's held since about 2015. And as the U.S. dollar bounced off that on Friday's close, that was a confirmation that we could see now, even as it works its way back to the 130 and into the potentially 140 range that we saw in March of 20, there's a lot of upsetting of the apple carts on the other end of this teeter-totter that could happen with all of these assets that have benefited as the dollar weakened.
Does that mean Canadians should be buying U.S. dollars right now?
Well, you have to have a portfolio approach and know what and how much and why and what your rules are around it. But certainly if people are looking for some U.S. dollars, for a purpose, perhaps traveling next winter or something like that, it is potential that the U.S. dollar will strengthen over the next little bit. So if you're looking to buy it as a Canadian, now is a relatively low period to do so.
If we have rapid inflation, does that mean deflation is around the corner?
Well, we've had rapid inflation. We've had the highest inflation that we've seen in more than a decade. So the inflationary numbers, but as I've explained throughout this, if you look at what's driving the inflationary numbers, it's largely been financial assets and commodities. So those inputs, and again, what happens is as those inputs increase but wages do not and loan growth has not, so bank credit contracting while prices go up, and that just makes for the correction of the inflationary conditions in the first place. So we've had bottlenecks in supply, we've had tankers caught in canals. We've had a bunch of series of misfortunate events which have created some shipping issues for sure, and then the pandemic, of course, and some shortages and things like semiconductors, all that. But we're ramping all that up now. If you look at the production side, it is really going on all cylinders right now. So as prices sort of bring down consumption, as pent-up demand has already been spent in the lockdown phase, and as production rises faster than the consumption, you start to see the prices come down. And then the problem with these asset bubbles, and this is, the problem with central banks reverting to how do we pump asset bubbles every time there's a downturn to try and avoid prices from mean reverting, is, as I say, you set yourself up for a bigger and bigger collapse. And that's literally what we're poised for now. So, I'm not predicting that that's going to happen shortly or anything, but it is the historical way that we get out of these extreme inflationary periods is, some people hope that we can just go sideways, for example, in Canadian real estate or any of these other markets, that hopefully, we could just not see any gains for a decade or more, and potentially that could mean revert these extremely overvalued conditions. But as wise people have often noted, extreme markets don't correct themselves by going sideways. Unfortunately, they correct themselves by usually sharp periods of mean reversion, and it doesn't last just weeks. And this is the conditioning that's happened in the last downturn, because the collapse in the markets in March of 20 was revived so quickly because it was only a 3-week period. We have a whole generation of people that think that was a bear market and that, no biggie, no big deal, because you just hold on and buy more and it all works out. But a traditional actual bear market historically lasts between a year and 2 years, and it doesn't revive for a decade after that, in terms of where prices previously were at the peak. So this generation of participants today are all fixated on trading, on how do you play things, highly levered, tons of margin. Canadians have borrowed a lot against their real estate to buy things like stocks, options. All these highly levered things are not something that people can traditionally hold when prices fall, because they don't have the cash or the stability to do it. And as I say, when you're levered, you are having to make these loan payments even if prices are falling. So psychologically, this is quite a torturous mix, and people tend to then sell low and take losses, and it really just magnifies the whole downturn to in losses.
Danielle, is there any way to protect yourself if you expect this kind of market condition to appear shortly?
Absolutely. So I've talked about this in the past, but to appreciate the conditions you're in is the first thing. To educate yourself on the behaviors that are going on around you. And I often recommend for people, because there's many, many good books on this, but they aren't mainstream, because the mainstream is basically written and promoted by the sell side. the sell side of the finance business and the corporate sector, which is always trying to get people to buy their securities. So you really have to do some non-mainstream work. One excellent place to start it's a short 200-page read, is A Short History of Financial Euphoria by John Kenneth Galbraith. Of course, he was a Canadian, but one of the most famous economists of his time. But he wrote this book in 1954, 25 years after the crash of 29, and he was just doing a review of the euphoric conditions that precede market crashes, the behaviors, the thinking, the risk-seeking, the leverage, all the stuff that piles on. And when you pick up that book and just leaf through it for any few minutes, you'll start to appreciate that it's textbook of what we've lived through in the last year and a half. And so it really makes it, you should have an aha moment of, oh, so this time is not that different. This time is very typical. And in which case, you want to make sure that you are doing the opposite of the masses. So that means paying down your debt, not taking on leverage, reducing leverage wherever possible, not having all your money in stocks, looking at raising some cash and keeping it aside. Treasury bills, as I explained, are one of the few classes of assets that typically rise in value as everything else falls. So that would be, Canadian and government, Canadian and U.S. Government bonds. And the U.S. dollar, as I said, can be one of the few safe havens that doesn't mean you have to buy U.S. equities with it. You can actually have just the currency itself. And those are opportunities for you to maintain liquidity and principal security as everything else mean reverts. And then understanding that, for the masses, bull markets seem so much funner than bear markets, but you can flip that on its head such that a bear market brings great opportunity if you're prepared in advance. It does take self-discipline and patience, and you have to understand why you need to do things inverse to the masses, but you really do, because otherwise you just ride up and ride back down, and usually you're years set back in the process, and you're much worse off financially for it.
Danielle, thank you so much for chatting with us.
My pleasure.
My guest has been Danielle Park, editor of the popular blog Juggling Dynamite and president of Venable Park Investment Council Incorporated. Check out her websites, jugglingdynamite.com and venablepark.com. If you have any questions for Danielle or any of our other guests, you can send them to info@howstreet.com, our YouTube channel, Talk Digital Network. Find us on Twitter @HowStreet. We're also on Facebook. I'm Jim Goddard. Thank you for listening.
Comments made on HowStreet.com radio are an expression of opinion only and should not be construed in any matter whatsoever as recommendations to buy or sell any financial instrument at any time. Available online at TalkDigitalNetwork.com. HowStreet.com radio is a production of HowStreet Media Incorporated.